Okay, so now we're moving on to part three, which is my macro outlook. I've been in the markets 50 years, so I sort of feel like I have a very good understanding, although, everything evolves and does change, and you see that even now, especially with the central banks being so active in the markets. But this is going to be my take. So I would say that central banks, they're close to being done on rate hikes. They feel that they have got more control over inflation, but of course it's still not back to that 2% level, their target rate yet. Any increase in inflation, which I want to highlight, that is possible around sort of September, October time. If you look, oil prices are higher again, over $80, and grains as well, just because Russia refused to extend that channel which allowed Ukraine to export, and in fact Russia then started to bomb some of the ports, Ukrainian ports. So that could have an impact, but I'll come to that because also we've got to take other factors into consideration there. So once the excitement of central bank rate hikes is over, what do we do next? What are traders and investors going to focus on? Will it be sort of unemployment? Will it, recessions? What are we looking for there? And also, how quickly are they likely to cut? And, I think that so many traders and investors are going to be disappointed because I still maintain that it's going to be next year, 2024, before there are any rate cuts. And any rate cuts are going to be slow because what they're not going to want to do is fuel inflation again. They're going to be very cautious. Inflation has scared central banks. Let's be clear about that. For me, the US continues to be the strongest economy. And again, that surprises so many people. But when you look at the amount of stimulus that they've put in there, for me, it doesn't. And every week they still just demonstrate with their data that they've got the strongest economy against its peers. Now, it's possible that the US could actually end up and actually get away with that soft landing. I don't believe that's possible for Europe and the UK. I think that they have to suffer a recession. And they're going to get, they've got slow growth, they've got higher inflation than the US. And I don't think that that's going to change anytime soon. Which, for me, rates may have to go up a little bit more, but, they're still below US rates anyway. But more importantly, I just think that Europe and the UK can't handle these rates as easy as it's being done in America. And the big difference for me is the fact of the amount of stimulus that was put into the US over COVID. So despite all the rate hikes, GDP grew in the second quarter. Inflation is slowly dropping in the US. Consumer spending increased, and the labour market in the US is still near its all-time high. And that's, when you look at rates have gone from 0 to over 5%. And of course now even Japan has finally begun to shift its policy, even though it's just a slight tweak. They've sort of adjusted its yield curve control, YCC. And they're pushing the 10-year yield from 0.5% to 1%. Again, it just wouldn't surprise me if by the end of this year that they actually move their rates going from negative 0.1% to par, or maybe even plus 0.1%. So, there is that potential for a slight adjustment there, I believe now. And of course, they've got their recent new governor there, Ueda, so he may just tweak things and obviously make those decisions his going forward, not his predecessors. Okay, so Russia warned Poland against any aggression towards Belarus because that would drag them into the war. And again, that's such a delicate position there. And of course, Ukraine's new counter-offense, again, is surprising because it's going slower than they expected against Russian positions. So, everyone was sort of hopeful that that was going to be a very quick counter-offensive, but that's not actually happening. The Russians are digging in quite well at the moment. So, everything that's going on around the world, and of course we've had OPEC Plus cutting oil supply on 3 different occasions this year, and now they are starting to see a little bit of progress because we've now got oil WTI back over $80 at the end of last week. So I doubt it's, I don't think that OPEC will do anything at their next meeting now because of that. They probably feel that it's moving in the right direction for them. Now, the weather does also continue to push temperatures higher, and that's thanks to El Nino. And with that extreme heat and, of course, less rain as well, again, we could see lower grain yields, so you could get lower quality and also lower quantity there. And, these could really sort of give inflation another little bump probably around September, October time, which will obviously be very unwelcome by the central bank. So just keep an eye on those prices. And of course that lack of workers is still there, so it's keeping wages higher. It's a surprise, but in the US it's understandable because there's just a demand there. But when you look at manufacturing, and now services starting to slip in Europe, for me personally, I still expect there to be job losses and unemployment to increase probably over the rest of this year. As I say, I do expect Europe to go into recession at some stage, whether it's the end of this year or early next year. And then, of course, we've had some corporate earnings coming out for the second quarter. And they're still being released, but for most, they've been sort of enjoying the highest profit margins for decades. That corporate greed is still there, and of course, it is one of the reasons why inflation is taking so long to come down. The dollar recovered a little. I've been mentioning that it seemed undervalued, but when I look at the macro picture, where interest rates are, where economies are, I've still got to say I think that the dollar's cheap against the euro and the pound at least. Now, that is not a recommendation. That is just my personal view. But, I've been a fan of the dollar for the last 3 or 4 years. And, it's not that I won't change my opinion. It's just that I don't think I need to change my opinion. All you've got to do is look at the macro outlooks. Everyone seems to be just too focused on rates. So, gold steadied again. So that was very good, pushed higher back through the 2000. However, digital gold didn't have the same luck. That sort of dropped back below 30,000. So a little bit of a contrast there. So if we look at the stock market though, it spent another week sort of, okay, it was bouncing around and it was having big ranges. But it just seems to be consolidating at the moment. But there were some great opportunities on the data last week for sure. And of course this week it's going to be interesting with the data that's coming out. But also, we've heard that China's sort of pledged to boost their economy. Although that real estate does sort of remain a challenge for them, and that's holding them back, I would say. So it's going to depend on how aggressive they are with further stimulus. Looking at Tesla, they've been producing EVs for 5 years now. It seems most owners actually love them. They just don't love Musk. And I have to say, I'm in the UK, and I see more and more, almost on a daily basis. And I live outside of London, but yeah, they seem to be picking up. It was quite strange. At one stage, they all seemed to be white, but now I'm seeing lots more different colours as well. Blacks, blues, reds, I think. But manufacturing continues to contract in most countries. It's just a case of how much further it can go. It's so negative at the moment. But on the other side of that, services has remained steady. So just to finish, this week with all this employment data that's coming out, it's going to be another interesting week. Again, I just want to emphasise it's the start of August, so there's going to be more and more traders start to take time off to have that quality time with their family. They take a break, 2 weeks, a month, whatever. Therefore, you tend to get a little bit less volume going through the markets. Now, that does lead to higher volatility, not lower volatility, because any volume that does come in will push the prices further. And of course, volatility. Do we actually need anything else when you look at what the markets have been doing in recent weeks? So, so that's sort of my macro outlook. All I can do is just say, just be a little bit careful going through August. Perhaps reduce your size down and have wider stops. By doing that, you can adjust the size of your trades, and that allows you to have a wider stop, but without increasing the potential loss, which is important. You don't want to be running up big losses, but certainly in August. December is another month, which is what I was going to say, because in August and December are probably the two where there's the least volume in the markets, and that does tend to lead to a bit more volatility. Okay, so let's move on. Hope you stay with us for part 4 and the technical analysis. Before I do that, again, just highlighting, I'm not going to go through it, but we offer fantastic services when it comes to helping you with your trading. Whether it's just filling in your gaps or getting you those foundations that you need to have a trading career. We all want to improve. Maybe you want to learn a new asset class, one that you're not familiar with. Recently I did a course for a banker. He's been in the market for decades, but he had one asset class. That was his expertise. And he wanted to reach out and do a week with me to find out about other asset classes as well, around commodities and such like. So that's I can do that for you. I've traded all the asset classes for decades. So and of course just that macro trading, technical analysis, so risk management, of course, so many different areas that I can help you with. So if you're interested, you can either contact us at info@symaxfintech.com, or you can just come straight to me at chris.tubby@symax-int.com. Hope to hear from you.